Hello and welcome to our revision on preparation of published financial statements. Recall in our revision class we mentioned that a complete set of published financial statements include a statement of comprehensive income, a statement of financial position, and a statement of cash flows. Now in this lesson or in this class, we'll be solving a question on December 2023, which was question 4. And the question was a cash flow question. The question reads, the following financial information was extracted from the records of Bundo Limited, a public limited company. We have the statement of financial position as of 31st October 2023 and 2022. So we have the two balance sheets for the 2 years. We have the non-current assets, the current assets, equity and liabilities, and we also have a statement of comprehensive income for the year ended 31st October 2023. We have the revenue, the cost of sales, the gross profit, the distribution cost, the admin expenses, the profit from operations there. And then we have the finance cost, the profit before tax, and the income tax expense. We also given the profit for the year, and other comprehensive income include revaluation gain on property, which is net of deferred tax, and the total comprehensive income for the year we are given there. So we have additional information. Number 1 says the property, plant and equipment was made up as follows. So we have for 31st October 2023 and 31st October 2022, we have the cost of valuation. We have for the 2 years, we have the accumulated depreciation, and if you less accumulated depreciation from the cost of valuation, you get the carrying amount there. So we are told that during the year ended 31st October 2023, the property was revalued upwards for a gain amounting to 1.2 million. The company does not make any transfers for excess depreciation upon revaluation. However, it accounts for deferred tax on revaluation gain. The income tax applicable to Bundo Limited is 30%. Depreciation on PPE has been charged to the profit or loss account. So we have additional information number 2. It reads that during the year ended 31st October 2023, Bundo Limited acquired some patent rights at a cost of 5 million. Fine. Any amortization of intangible assets included in the admin expenses is included in the admin expenses. Fine. Number 3, the company repaid some borrowings which had matured during the year and issued new loans amounting to 3 million. You are required to prepare a statement of cash flows for Bundo Limited for the year ended 31st October 2023 using the indirect method in accordance with the requirements of IAS 7 statement of cash flows. Fine. So let's go ahead and solve that question. So we have our balance sheet there. We also have our income statement here. Recall that a statement of cash flows has 3 parts. We have the operating activities, we have the financing activities, and we have the investing activities. Those are the 3 parts we have in a statement of cash flows. Now let's go ahead and prepare this. Let's go ahead and solve this question. So we have, this is December 2023, question 4. This is December 2023, question 4. So we are told to prepare using the indirect method. So let's start with the title. The name of the company is Bundo Limited. So we have Bundo Limited. Statement of cash flows. Statement of cash flows. Statement of cash flows for the year ended. 31st October 2023. 31st October 2023. So that is our title there. Our level of accuracy is in shillings in thousands. Our level of precision is in shillings in thousands. So we usually start with the operating activities. So cash flows from operating activities. Operating activities. Now from operating activities, we usually start with the profit before tax, and then we adjust for any non-cash items. So we have profit before tax. So the profit before tax in this case was, let's go back to our income statement and identify the profit before tax. So this is our income statement, and you can see the profit before tax. Here it is. The profit before tax was 18,700 shillings. So we have profit before tax is 18,700. That is our profit before tax. We go ahead and make the adjustment. So adjustment. So we are adjusting for non-cash items. There are two adjustments that you should always look out for because they rarely miss. The first one is depreciation. And the other one is finance cost. So the reason why I'm saying that these two items rarely miss on the adjustment for profit before tax is because if a company has assets, automatically those assets will depreciate. And if a company has borrowed, automatically they will pay interest on the loans they have borrowed, and that interest is what we are calling the finance cost. Now these two are non-cash items, or they are not part of the operating activities of a business. That is why we are adjusting them from the profit before tax. So let's go ahead and work out the depreciation, or we can even start with the let's start with the depreciation. So I'll come over here right on this side and have my workings. I can have my workings here. So working one, remember that assets are the ones which are depreciating. So we can go back to the balance sheet and check whether the assets we have depreciated. So let's go back to the balance sheet. So we have our balance sheet here. So you can tell that from our balance sheet we have 118,400 and 113,600. So the assets have actually increased, which can imply that the company has acquired assets. But when we are preparing a PPE account, it is recommended that we prepare it on cost. The PPE account should be prepared on cost. So let's go ahead and prepare the PPE account. From this information we have from additional information number 1, we are given the property, plant and equipment was made up as follows. So we have the cost of the PPE for 2023 and for 2022. So we can go ahead and prepare that. The PPE account. Working 1, PPE. So we have the PPE account and we are going to prepare it on cost. So we have the PPE account there. So we have the balance brought down. So the balance brought down is from the previous period. Oh, okay. It should be on the credit side. On the debit side, this is an asset. Should be on the debit side. So we have the balance brought down. So this is from the previous period. Can go back to our question. And we have our balance brought down from the previous period is 126,200. 126,200. So we have 126,200. And then we have our balance carried down. Our balance carried down in this case will be, let's go back to our question. So from our question, our balance is 138,200. Our balance is 138,200. Now, from the additional information number 1, we can also see that it's actually additional information number 2. No, additional information number 1. So during the year ended 31st October 2023, the property was revalued upwards for a gain of 1.2 million. So the property was revalued upwards. So we are going to debit that revaluation gain. So we have a revaluation gain of 1.2 million. $1.2 million. Now we get the balancing figure. I did not see any other information affecting the PPE. So we have 138,200. So 138,200 minus 1,200 minus 126, we get a balancing figure of 10,800. 800. So this means that the company had acquired PPE. This means that the company had acquired PPE. So you have acquisitions. So let's go ahead and prepare now the depreciation account. So this is working to depreciation. So we go back to our question and check the accumulated depreciation. So the accumulated depreciation, the balance brought down was 12,600. So we have balance brought down giving us 12,600, and we have the balance carried down. Let's check the balance carried down. The balance carried down in this case was 19,800. So 19,800. So the balancing figure in this case will be 7,200. 19,800 minus 12,600 will give us 7,200. Now this was what was charged in the profit and loss account. So let's go ahead and record that as our depreciation. So we have depreciation is 7,200. So in this case, we are not going to less depreciation, we are going to add it back, mainly because it was less in the income statement. So we add it back. Next, we have finance cost. So for finance cost, we'll go back to the income statement. We are going to go back to the income statement. And from the income statement, we can see that the finance cost was 3,800. It was less, so we add it back. So 3,800, we add it back. Okay. We also have additional information number 2. So additional information number 2 reads that during the year ended 31st October 2023, Bundle Limited acquired some patent rights at a cost of 5 million. Any amortization of the patents of the intangible assets has been included in the administrative expenses. So if this amortization is included in the administrative expenses, this means that we are going to adjust it as an uncash item. So we have amortization. So let's go ahead and prepare the intangible assets account. So because we have here the intangible assets has been included in the administrative expenses. Now let's go ahead and prepare the intangible assets account. So to do that, let's go back to our workings, and we have intangible assets. Remember, we want to check whether, or we want to calculate the amortization of those intangible assets. So we have from our balance sheet, the intangible assets, the balance brought down was 23,680. The balance brought down was 23,680, and the balance carried down was 24,290. The balance carried down was 24,290. Now we are informed that they acquired, from additional information number 2, they acquired intangible, they acquired patents. At a cost of 5 million. So let's go ahead and reflect that here. Patents at a cost of 5 million. Now let us get the amortization figure, the figure for amortization as our balancing figure. So we have let's calculate that. Mm-hmm. 23,680 plus 5,000, giving us 28,680, and 28,680. 28,680 minus 24,290, giving us a balance of a balancing figure of 4,390. 4,390. That will now be our amortization. So let's record this in our cash flow statement. $4,390. So I don't think there is anything else we have not included as the adjustments. We can go ahead and bring in the working capital changes. We can now go ahead and bring in the working capital changes. So working capital changes. Recall from our lessons that we said working capital includes current assets and current liabilities, but for the purposes of cash flow statements, we are going to ignore cash at bank, cash and cash equivalents, and bank overdrafts. We are going to ignore those. So the items we are going to look at are inventory, whether it's an increase or a decrease, receivables and payables. So for inventory, we are going to check whether the inventory has actually increased or decreased. So if inventory has increased, this means that we have spent money to buy or to purchase inventory. So if we have spent money, then we are going to less. So let's check. From our balance sheet. From our balance sheet, we can see that from 2022, we had 5760 and 5880. So it has increased. So 5760 from 5760 to 5880, that's an increase. So let's record that. Let's also check even receivables from 4290 to 4070. So the receivable have actually reduced. This means they paid, so we are going to add it back. Let's check the payables. So for the payables, we have here from 8200 to 7800. It has reduced. This means we have spent money to pay for those payables. Payables are debt, so we have paid up some of our debts. So we are going to less that. So let's go ahead and record it. So inventory from 5880 to 5760. And then payables from 4290 to 4070. So 4070 minus 4290. And then lastly we have payables 7800 all the way to 8200. So 5870 minus 5880 minus 5760, that will give us 120. So we are going to less that 120. This is giving us 220. We are going to add it back, and this is giving us 400. So we are going to less 400. So if we add all these, this will give us the gross operating cash flow. So let's go ahead and add this, the gross operating cash flows. So after I've added these, I'm getting 33,790. 33,790. So after that, we can go ahead and get the tax paid and the interest paid. So we less interest paid, and we also again less the tax paid. We less the interest paid and the tax paid. So let's start with the interest. Let's do some working. So this is working number 3. This is working number 3. So we go ahead and look at working number 4. Working number 4 is interest paid. We want to figure out how much interest was paid. Now we go back to the balance sheet and check the balances. So from the balance sheet, you can tell that we have interest payable as a current liabilities. We have the balance carried down is 4,800 and the other one is 3,500. So the interest payable balance brought down is that 4,800, and the balance carried down, we have it as 3,500. So we go back to the income statement and check the figure. From the income statement, we get what was paid that year, that current year. So from the income statement, we have finance cost being 3,800. So we go ahead and include it here. From the P&L, we have it as 3800. Now we add it here. We add it. We have 4800 plus 3800 is giving me 8600. We less 8600 from 3500. We get the interest paid as 5100. So we go ahead and record that. We less it, so we go ahead and solve for tax paid. Tax paid. So that will be our working number 5. So our tax paid, we're going to get the balancing figures, or simply the balances from the balance sheet. We start with the balance brought down. I can see we have both deferred tax and current tax. So let's open the balance sheet. So from the balance sheet, we have the current tax here in the current liabilities and deferred tax in the non-current liabilities. So let's go ahead and use them together. So we have deferred tax and we also have current tax. So deferred tax is 7070. Here it is, 7070. The current tax is 5570. And we have the balance carried down. The balance carried down in this case, we have it as 6750 and 4230 for current tax, deferred tax and current tax. So the current tax figure is 4230. So from the P&L, let's check. Income tax expense is given as 4830, so let's record that. From the P&L, we have it as 4830. So remember that our goal for this account is to figure out the tax that was paid for that year. And for evaluation, we are told that we had that point. It was point number 1, I think. Let's check. So during the year ended 31st October 2023, the property was revalued upwards for a gain amounting to 1.2 million. The company did not make any transfers for excess depreciation upon revaluation. However, it accounts for deferred tax on revaluation gain, and the income tax rate applicable to Bundo Limited is 30%. Depreciation on PPE is charged to the profit and loss. So we have that revaluation gain. So that revaluation gain will be subject to depreciation at the rate of 30%. At the rate of 30%. So let's go ahead and include that. We have revaluation. We have 30% multiplied by 1200. 30% multiplied by 1200, this is giving us 360. Now my account is complete. Let me go ahead and balance it off. So the total this side is giving me 17,830. So the difference here is giving me the tax paid for the year. Tax paid for the year, which is 6,850. 6,850. So let me go ahead and record that. Tax paid is 6,850. So let me get the net cash flows from operating activities. So 33,790 minus 5,100 minus 6,870, that is giving me 21,840. Let me write it on the other column as 21,840. Now we go to the next one, which is investing activities.